Hello and welcome to this special edition of Swinecast, featuring presentations from Swine Forecast 2009, a virtual conference featuring speakers from North America and the United Kingdom on topics relevant to this extraordinary time in the swine industry. The conference took place on Thursday, November 20th, and was attended by producer groups in more than 30 locations across the U.S. and Canada. Conference sponsors in alphabetical order were Elanco Animal Health, JBS United Incorporated, Pfizer, Swinecast.com, and Zinpro. At the end of the presentations, an extended question and answer period received questions from many of the producers gathered in small groups around the country. So, this is Swine Forecast 2009. Sit back and enjoy. First up, Dr. Steve Meyer founded Paragon Economics in 2002 to provide expert economic analysis of agricultural markets and business decisions. Presents his U.S. market review.
Good morning, everyone. It's a pleasure to be with you this morning to provide a market review for the Swine Forecast program this morning. We're going to run through quite a few slides in a pretty short amount of time here, so let's get going. The driver of most things economic these days, in my opinion, is what's happening with oil prices. I've been telling people I used to never have a slide of oil prices in an Outlook session, but I always do now because we have created a direct link between oil and corn prices with our biofuel policy. Of course, oil peaked out in July at $147 and change per barrel. It was $55 on Monday when these slides were made. You can see the correlation here that corn has moved pretty much lockstep with oil since late 2006. And there has been a bit of separation in recent weeks. If you kind of look carefully at the end weeks of this graph, the black line representing corn has hit a bottom, or at least some support around 380, and oil prices have continued to decline. At some point here, the renewable fuel standard will kick in and will cause corn to kind of hit a bottom. We can't make the economics of ethanol plants work at 380 with $1.70 or $1.60 ethanol at the present time. But this is one of those things where we've said for a long time that if that renewable fuel standard becomes a binding mandate, that we'll change these price relationships from what a market would suggest that they would be. And so it's certainly looking like we're having some situations where corn is maybe finding a floor. It's a little higher than what the economics would suggest. How much corn will go to ethanol in the coming year? That's a question. USDA has said 4 billion bushels. The renewable fuel standards calls for using 3.75 billion bushels. Our capacity to make corn into ethanol currently is somewhere in the mid 3 billion bushel range. There's another 4 to 5 billion gallons of output capacity that are still under construction or could be opened in the next year. So that would push us up near 5 billion bushels of corn as far as capacity goes. Here's the usage patterns over the last 30 years plus, or for almost 40 years. And we can see that feed and residual has kind of topped out. It's down pretty sharply this year, according to USDA, this coming year. Exports hit a record last year, and they're going down, but they have been pretty much the same for a decade or more now as well. And food and industrial usage other than ethanol, which is mainly high fructose corn syrup, has been steady for about 15 years too. The one that's grown has been ethanol. It's gone up by a factor of 3 in the last 5 years, the current forecast being 4 billion bushels, but we do have capacity to use maybe 5 billion. And so the economics of ethanol production are going to be very important this next year. And with dropping oil prices, that means dropping ethanol prices, and we could put a little pressure on usage. Will the ethanol plants survive? Well, I think ethanol plants surviving and ethanol plants surviving under the current ownership are certainly two different questions. There will be some bankruptcies. There will be some write-downs of debts. There may be changes of ownership. But the real question is, will they operate at full capacity of 13 to 15 billion gallons or somewhere around 5 billion bushels of corn? It doesn't look like they're going to do that this coming year. But I'm still concerned they might get a little closer than what USDA has said. On the as far as the margin business on ethanol goes, this is a chart from Iowa State Center for Ag and Rural Development. The top of this line, the top of the buff-colored area here, is the price of ethanol, and we can see that it's gone down sharply since last summer. The buff-colored area is the amount spent for energy. The red color is the amount spent for corn. The blue is gross margin above those two items, and from that, all the cost of labor and plant and equipment and logistics have to be paid. And we can see that we've just barely been covering, we've had gross margins of about 25 to 30 cents per bushel for some time now. And that as the ethanol price has fallen, it has been taken pretty much directly out of corn price. So falling oil and falling ethanol is good news for livestock feeders, no question, but there are some restrictions there with the renewable fuel standard that will keep those from going down past a certain level. Carryouts for this corn crop are predicted to be about 9% of total use. That carryout figure in bushels is 1.1 billion. This year's carryout was 1.5 billion. And so I think we're going to be really on kind of the precipice of some tough times again on feed prices as we go into next spring. We have found kind of a bottom, or at least support here at about 380 on corn. We've been bouncing off of that for some time. We're pretty well. We got combines running in Iowa again this week, finally, after a couple of weeks of delay due to wet conditions. But whoops, I don't know what happened there. But it does look like we're going to be in this $3 to $4 range, maybe the upper threes on corn. Soybean meal found some support at about $240 a ton, so I would say probably in the 250 to 280, 290 range on soybean meal looks to be something that we're going to have to deal with. And that's kind of where we are on the futures right now. This graph is the cost of corn and soybean meal to make a 16% crude protein diet. Historically, you can see the spikes we've had in the past in 95 and 96, and then a small one again in early 2004 until that crop really developed into a great crop. Of course, the run-up the last year has been demand-driven, not supply-driven. And probably the run-up from $200 to $280 there might have been supply fears in June and July. But these futures, as we project this cost into 2009, have come down dramatically since July. They're about at their lowest levels that they've been since early 2007, and they're probably a pretty good buying opportunity for feed prices for hog producers going into next year. What does this mean for cost? Well, based on Iowa State University's estimated costs and returns, this would imply costs, and the red line here would be predicted costs for the rest of this year and out into next year, would imply cost of $70, a little less than $70 per hundredweight on a carcass weight basis. The blue line there is a predicted Iowa, Minnesota cash hog price based off of the futures market on Monday, and we can see that it says losses for the rest of this year and into next year, but some profits in the summertime. And as a matter of fact, if you add all those up and average them out for next year, they come up with a profit of about $244 a head for the year of 2009, but that's after $40 more per head losses here in November and December. If we look at profitability historically, we've come off this time of tremendous profits in 04 through 07, and it allowed producers to be pretty well heeled. But large losses last winter, and we're going to be back down close to that $40 mark again here in November and December, it looks like, especially as these cash markets have softened through the month. We look at accumulated wealth. This is just kind of a measure of producers' wealth position or balance sheet. If you had sold one pig per month since 1991 and put the profits in a bank account paying zero interest, which I kidded a group of bankers day before yesterday, that's about what they usually pay on savings accounts. This would be the balance in the savings account, and it got up to about $460 back in 97. It took us 8 years to get back there, all the way to 2005, and then we set a record last fall in September of nearly $800. We've come down about 30% since that. If we add in 2 more months of $40 loss, we're going to go down another 10%. So obviously, good financial position has helped some producers weather this storm. But that financial position is certainly deteriorating as we go forward. What are the incentives? Number one is, I guess I would point out that producers still have some financial wherewithal. Number two is the forecasted profits for next year are positive, small but positive, not negative. So I don't think there are a lot of incentives for large-scale cutbacks in the U.S. We'll talk about some of that as we go through. The wild card is going to be feed cost, and we're going to be kind of on the precipice of very high feed costs again next year, and any hiccup in weather or planting can really cause us some problems. On the demand side, it's been a tough 3 years for meat demand in the U.S., and this year is no exception. The index of domestic consumer-level demands are down for all three species. Earlier in the year, pork was up. Broilers were up until just this last month, but all have softened. Part of the problem here is some kind of problems with some data problems and time lags of price responses to quantities. Per capita consumption in the U.S. is down this year, but it's mainly down because we've exported so much product. And retail prices did not adjust quickly to that. And right now, consumption is down. Prices have not gone up enough to offset those, and so the demand index figures are down as well. Exports, of course, have been a tremendous story this year, with several months this summer double where they were a year ago. We're now up 67% year to date, and that says September an estimate number. It was an estimate of the carcass weight equivalent at the time I made this slide. That number is about correct from what USDA has published since that date, but still a tremendous year for exports. If we look at exports by destination, we can clearly see that the driver of growth this year was China and Hong Kong. But the September figures were 78% lower than where they were back in May. They spent 2 months as our largest customer, and for a number of, over a year, I've been posing the question, what happens to China after the Olympics? We may be seeing what happens after the Olympics here. Certainly a reduction in the amount of pork that they brought in, and some rebuilding of their herd is going on. We know that they kept a lot of gilts back to replace sows that were lost in both the disease problems of 2 years ago and the earthquake of last year. Still growth to Japan, still our number one market. Mexico has seen a nice rebound this year after a tough 2007 in that market. So it's been a good year across the board, and part of it was driven by a lower dollar. The other one was that if we look at the rally we saw in lean hog prices this past summer, they were driven by cut prices. And I know this is a very busy graph, but I'd ask you to focus your attention on the blue line, the green line, and there's a purple line with crosshatches in there that represents hams. Those went from 25 to 40 cents, depending on which one you're talking about, way up near $1 this summer. 42% Kim Lean trim traded for 90 cents. 72% Kim Lean trim was $1.07. Hams were up in the 90-cent range in August, and that just doesn't happen in the U.S. market. All driven by tremendous export interest this summer, and it pulled up the range of wholesale cut prices from the most expensive to the least expensive. That range is the smallest on record there in August, the second week of August this year, and it saw record high cutout values and record high live hog prices this summer, and so that was an unexpected bonus this year. We certainly didn't expect that. I don't know how you would have ever predicted it. The other point about exports is they've driven byproduct values up to record levels as well. We reached $23, $24 per head in late summer. That's come back to about 20, but this is a number that used to bounce around 10 most of the time, and so we've certainly added value to hogs by the value that we've added to organ meats and snouts and those a lot of cuts that aren't highly utilized here in the U.S. One of the reasons that price has backed off some, or that value has, that fat has gotten less expensive as corn prices have come down. So how will the stronger U.S. dollar impact exports? Well, in a trite response, it will hurt. It will make U.S. products more expensive in international markets, but the dollar is still pretty weak in historical terms. And we set the first 10 of our 16 straight record years for exports with a strong dollar. So I think we'll still do well in the export market. Will we have the kind of growth we've had this year? I don't think there's any way we can expect that. As a matter of fact, I don't think exports will go down because there's going to be cutbacks in output of major competitors around the world, and there's not very many other places that are going to turn. This one is an index of exchange rates, and I am a bit concerned about especially the red line there. That's the peso, which has lost about 30% of its value in the last 6-8 weeks. In addition, the Brazilian real, the purple line, has lost value as well. That makes their product more competitive with ours in world markets. We see the same thing for the Canadian dollar and the euro, or the pink and light blue lines kind of down at the bottom. We've been hearing reports that Canadian product is far more competitive in international markets recently, and some of our packers have certainly dealt with that. The one point I would also make about is the brown line there is the Chinese renminbi or yuan. Of course, at one time it was pegged to the dollar, where you see there at one, it stays on that one line for a long time. They have manipulated that some since that time, but you won't see it change like these others because it's not a floating currency. I still think at some point the world's going to make them float that currency, but it's not happening yet. On supply side, the September hogs and pigs report said we were cutting back the breeding herd down 2.4%. We still had a larger market herd as of September 1. Pretty much as expected prior to that report, except for a few numbers. One of them was this 120 to 179 pound inventory, which we looked at that number when it was published and said that really looks screwy. As we've looked at slaughter since then, that's confirmed our suspicion of it. Reduced September, November intentions about 4.5% down. Smaller reductions for December and February intentions. It's interesting that those breedings would have occurred during that price rally in July and August. On the pig crop, up slightly, and a big jump in litter size. Productivity, that's the largest gain since 1997. The 97 gain was, of course, driven by structural changes. This one is driven just by better management and culling less productive sows. We look at slaughter numbers. We can see the shortage of actual slaughter, the green line there, relative to the red line, which I had predicted for slaughter coming out of the September report. A part of that shortcoming is because of fewer Canadian market hogs coming south, but the other one is that it certainly looks like they overcounted that one class of pigs. Going forward, I think there's an outside chance we've seen the high slaughter week of the year. The week after Thanksgiving is a pretty good bet, but I think we've probably taken the 2.5s out of this possibility, and we're in the 2.4 range as the high run of the year. Going forward to 2009, the pink line, about the same for the first quarter, then significantly lower supplies going into the second quarter, and the summer farrowings there will really depend on, or summer slaughter will really depend on what happens on those Feb intentions, if they are, in fact, a little higher than the August-November intentions. The cutbacks in the breeding herd are substantial in Canada. They revised all of their first 3 quarters of this year downward in the October report, and October shows that they were down 8.3%. We were down 2.6%. This 4% reduction in the North American breeding herd is the largest since back in 2000, and I think that's going to get deeper before it gets better. Canada is going to continue to liquidate some. I think the U.S. is going to continue to liquidate sows at a slow pace here for another 2 or 3 quarters probably. We don't turn this thing on a dime. But the incentives to cut back are certainly less now than they were, given where the futures prices are. Canadian market hogs have gone down, and part of the reason there is mandatory country of origin labeling. There are a few plants that are going to kill Canadian market hogs, but it's going to necessitate a third label in many of them, and I don't know that they're going to do much of that. What's the potential impacts here? I think, and I'm not going to read this for you, we got the rules pretty in place, and I think plans are there. The wild card in my mind is what are consumers going to do react to the multi-country label. I do not think Canada is going to be a negative. Beef, on the other hand, with Mexico and Uruguay and Paraguay and Brazil and Argentina, and they could have a lot of countries that aren't nearly as trusted as Canada by U.S. consumers. I think that's going to be a problem, but I really don't think Canada is going to be a big deal. And if that's the case, eventually these Canadian feeder and weaner pigs will be wanted here, and some reports out of Canada that I've had the last 3 weeks is, yeah, but are any of the producers of those pigs going to be left, because they're taking some huge discounts right now. Supplies for the rest of this year, I've got fourth quarter slaughter up 2.2%, pretty much in line with some of my colleagues at some other places around the country. 31 million head for this fall. That's just a shocking number. If we look back, 27 million head caused all the problems in 1998, and yet we're going to handle 31 million heads and do a pretty good job of it. As for next year, I see supplies getting smaller, some response to these the losses we've had, but not a huge response. I've got it down 2.4% for the year. The Livestock Marketing Information Center has it down 2.7%. Not a large cutback in U.S. In hog slaughter next year. For prices, 62 to 66 was my fourth quarter forecast. That looks like it's going to be a little high right now, given where cash hogs have gone. If we take the lean hog index plus the December hog contract, they're sitting right at $60. For next year, about the same in the first quarter, some strength in the second and third quarter, and the fourth quarter, of course, weaker again. About 10% higher prices for next year than what we have this year. One point I would make is that this is the first time in about 3 or 4 years that my forecasts have been higher than the lean hog futures prices. We ran a long time where the futures prices were premium to what my forecasts were saying, and producers really took advantage of that to a great degree and hedged hogs and did a great job and earned more money than they would have on the spot market. I think the reduced impact role that the funds are playing right now as the financial crisis is worsened has taken some of the positive side out of the commodities markets across the board, including lean hogs. And so there's not as many hedging opportunities there right now. I think cash prices actually might be a little stronger than what they have. So my expectations, higher meat prices led by chicken this winter. Chicken's making some huge cutbacks right now, record egg set reductions. Hog prices, the short term lower, probably not lower than where we are now, but that's lower than what my forecast had been. In 2009, higher as supplies fall. How much more breeding herd reduction will there be in Canada? I think that's a big question, especially with the weakening of the Canadian dollar. That's put about $20 per head back in Canadian producers' pockets without anything else changing. Constant weights may be growing slightly. I'm looking for a sharp increase in productivity. I think there'll be a lot of incentives to get that done. And will the cutbacks be enough to keep the industry profitable? I don't know the answer to that one yet, but there's not many incentives to cut back a lot. The risks, the big one is demand, mainly as a function of the financial crisis, and exports are a big part of that. Exports, declining growth rate is virtually certain. Will they actually fall? I can argue yes, they will, because of exchange rates, and the poster child for that one is Mexico. I could also argue they won't, because where else are you going to buy pork? And with reductions in U.S. chicken supplies, where else are you going to buy protein? The wild card is China. 1.3 billion times any number is a great big number, so they have a big impact. Productivity growth may outstrip our breeding herd and breeding flock reductions in the case of chicken. A new round of cost increases in 2009. What are grain prices going to do when we get to bidding for acres? And if we have any weather problems, we are now 20 years and counting from our last real drought in the Midwest. And, of course, what will be the long-term impacts of mandatory country origin labeling? Will Congress go in and muckety-muck around in this law and change anything? They have threatened to do so. That was back in the summertime when they were getting what they thought was good cooperation out of packers. But I think that's changed some, and so maybe the chances of this are smaller.
Dr. Steve Meyer of Paragon Economics with his U.S. market review on Swinecast, your connection at your convenience. This special Swinecast episode featuring presentations from Swine Forecast 2009, a virtual conference sponsored by Zinpro, Swinecast, Pfizer, JBS United, and Elanco Animal Health. Swinecast is a production of Truffle Media Networks, which is solely responsible for its content and may not reflect the views, opinions, or positions of our sponsors. This Swinecast program is designed with you, our listener, in mind. Thanks for hooking up today, and let us know what you thought about this program and possible future topics you'd find of value. Send those comments to me at feedback@swinecast.com. Always good to be with you. I'm Ned Arthur, and we'll be talking soon.